The election is over and irrational exuberance has taken over the equity and crypto markets. Are the Mag 7 stocks distorting the markets today? And what is the 10-year telling us about 2025? These topics and more on this episode of Investment Insights from Opal Capital. Thanks for tuning in to this episode. My name is Jay Coulter. Joining me as always, Austin Graff and Adam Mueller. Let's start with our charts of interest. The first chart on the screen today comes from Charlie Bilelo of Creative Planning, and it shows the market returns and the euphoria that we're seeing from the election up until the end of November. Austin, what's your takeaway?
I think this just highlights how the market's really been driven by animal spirits since the election. A lot of people are trying to identify underlying fundamentals, coming up with different stories to support this market growth. But when you look at the actual asset classes that are contributing to the returns, it can only be described by animal spirits at this point. And I would just recommend people sit back and think through what's actually driving fundamentals and what can be a tailwind following the election.
Adam, what are your thoughts?
Yeah, I would echo what Austin said. When you look at the top four performing categories on this chart, and they're all crypto-based, and the fifth is Trump's new BFF, it suggests that this isn't these aren't based on fundamental views. These are based on hope and optimism and assumptions around policy that may or may not occur. And I would take it all with a grain of salt. The fact that the number one trade has been Dogecoin, which is it's beyond speculative. It suggests that people may the irrational exuberance phrase may be at play here, particularly with respect to crypto.
Yep. So what is the bond market telling us about this? Take a look at this chart of the 10-year Treasury rate. The bond market knows best. Adam, what are your thoughts?
Look, I think, the bond market is it's always trying to tell you something. And I think what we're seeing right now is some concern around what's going to happen with the U.S. deficit over the next few years, a concern that bond vigilantes are going to return at some point. And the market's sort of trying to find its footing as the yield curve sort of recalibrates to a shape that it's supposed to have. And concerns about future inflation start to kind of creep back in. And all that's going on in sort of a sea of uncertainty around, again, which policies are actually going to happen. What is bluster, negotiation tactics versus actual sort of serious policy? And of course, I'm talking about all of the tariff rhetoric we've heard. And no one really knows. So I would just expect the bond market and the equity market to be much more volatile over the next 6 to 12 months.
Austin, what are your thoughts?
Yeah, I think Adam's right. Volatility should be expected going forward. One of the things, though, I would say, that if you just look back past kind of the Ben Bernanke era of quantitative easing, we're actually not at that kind of high of a yield market, right? And so as people are talking about bond vigilantes, like it's a great kind of term to throw around, but there are no bond vigilantes on the scene right now, right? This is really just an environment that's more normal than the Fed and different government entities trying to manipulate what's going on in the bond market. If we do see bond vigilantes come to the scene, you should expect a significant re-rating in the bond market and the equities market. We just haven't seen that yet. And so if these policies or whatever campaign agenda turns into policies, we should expect bond interest rates to go up significantly from here. We actually saw a easing of bond yields as Scott Bessent was put in to the Treasury Secretary role, or expected to get that role. As I guess people are assuming there's going to be a grown-up at the table. But the actual result remains to be unknown. And so with the result being unknown, all we can say is there's likely to be volatility from here.
And if I just add one thing, if that's okay, I think kind of combining this look at the bond market with the previous chart showing the trades since the election. The scariest number that I've seen recently isn't on either chart, and it's actually the VIX at 13, which suggests that we're wrong about volatility. But to me, that's the calm before the storm. That's when you walk outside and everything seems just so relaxed because a hurricane or a tornado is about to destroy your house. I don't quite understand the complacency in the markets right now around volatility, and I certainly do expect that to be a very different looking chart 6 to 9 months from now.
Well, I think it's amazing that, like, it seems like the market believes that a political party can come in and just clear up all of the kind of difficulties that are going on in the economy, the deficit, the amount of, the amount of debt that the country has. It doesn't just go away, right? And if the party actually does come in and do the right thing, we're likely to see a lot of pain across markets, which is not reflected in the current kind of numbers in the market. If you look at the VIX, as Adam mentioned, if you look at bond yields, if you look at equity valuations, everything, there's just irrational exuberance across the board, to use a term from the 90s. And it's unclear. This could last for quite a while until people start to realize that, there's not a magic bullet here. It's going to take policies that require difficult decisions, and there's going to be trade-offs. And so I think investors should start thinking about what those trade-offs should be and where they want to be positioned for those trade-offs, rather than just focusing on what's gone up the most since the election.
Our next chart. It's a chart from Bank of America that shows weekly outflows from the past 4 weeks. And in fairness, this chart is about 2 weeks old, but it shows a 4-week stretch where outflows were the highest they'd ever been from tech stocks. Austin, what are your thoughts?
I think this shouldn't necessarily be all that surprising for people who have been watching the market. For about the last 3 to 5 months, we've seen tech stocks actually underperform the broader market quite considerably. And quite frankly, that's the area of the market that's had the most money flow into it if you look at the chart over the last couple of years. So as we see things normalize a little bit, you should expect money to flow out of the sector that's seen the most investment. Isn't that surprising? Could it last longer? Probably.
Adam, any thoughts about this chart? Any surprises at all at the outflow?
No, I'm not really that surprised. Look, I think tech valuations are stretched, and a lot of people that have owned those companies for the past few years have made a lot of money and probably want to lock some of that down. And then you've also got, Justice Department looking at various tech companies, headlines around does Google need to be broken up, an antitrust case against Microsoft, or an investigation into Microsoft. I think that headline was last week. So there are a lot there, and Trump hasn't, as the incoming president, hasn't always said the nicest things about some of the CEOs of these tech companies. They all might be flying to Florida right now to visit him and say all the right things, and maybe that will help. But in the meantime, if you've made a ton of money and you're trading at very rich valuations, why not take a little bit off the table?
Our next chart, let's talk about the Mag 7. I want to read some statistics out for you. So the Mag 7 has rallied by 148% since the beginning of 2023, accounting for almost all the S&P 500 gains. And then by comparison, the remaining 493 companies in the S&P 500 have only seen a 35% gain over that time period. While at the same time, the index itself returned 57%, almost 3 times less than the Mag 7. As a result, the Mag 7 stocks now reflect a near record 31% of the S&P 500. This has to have implications for investors. Adam, what are your thoughts?
Yeah, look, I think we've talked about this before, but the old adage of I own the S&P 500, so I own the market, and I can just not look at my account and let that ride, doesn't feel like it's sort of true at the moment. If you own the S&P 500 thinking you own the broad market, well, you kind of don't. You own a huge chunk of these large companies and then a sort of a stub position in everything else. And it's one of the most compelling times to think about an equal weight S&P 500 as opposed to the actual index.
Austin.
I think this chart just breeds complacency. As we talk to investors across the board, a number of clients think that all you have to do is buy 5 to 7 stocks and you're set for life. And that doesn't really make sense. These companies cannot continue to grow at this pace and outgrow the rest of the economy by such wide margins. And so over time, you would expect the rest of the market to kind of come up and generate more of the return. And you'll likely see negative returns from the Magnificent Seven. Now, it's really hard to time, but from a risk management perspective, investors should be focusing less on what's gone up most over the last year or 2 years and focusing more on high quality companies with solid fundamentals that have reasonable valuations. Now, that doesn't mean that all Mag 7 companies have horrible valuations. I would just focus a little bit more on those that are priced appropriately rather than those that, are benefiting from some of the animal spirits in the market right now.
Could I also add, I wish we would stop having these monikers for groups of companies, the Magnificent Seven. It sounds good, and it creates a psychological need to want to own it. There was, what was it in the 1960s, the Nifty 50? Like in 9 months, like just because nothing rhymes with crappy doesn't mean we won't be talking about the crappy 12. Like we got to get over this. Oh, they're magnificent. They must be what you should own. I mean, be careful with these. We like things that rhyme. We like these simplifying things, and the world's not always simple. So
do people not remember the tech wreck of 2022?
The tech wreck? Oh, there you go.
That's exactly the other end of this chart. That was prior to the numbers going up 148%, right? Yeah. And so it's not to say that there's another tech wreck or whatever you want to call it, but to Adam's point, like the rhymes are kind of stupid.
Yeah, the Magnificent Seven could turn into the FU5, and you want to be careful to avoid that.
The crappy 12 and the FU5. We need to go do some trademarking after the show, guys. All right, let's talk about the Buffett indicator, which, if you're not familiar with it, it's the total value of all publicly traded stocks divided by the GDP ratio. In a Fortune magazine interview back in 2001, Warren Buffett referred to it as probably the best single measure of where valuations stand at any given moment. Gentlemen, given the chart that you see on the screen, what is an investor supposed to do with this ratio today? Adam, let's start with you.
Well, you look, over the last year-ish, Buffett's been selling a lot of equities, right? He's sold down a huge chunk of his Apple stake, even though he still does own a lot of it. He's sold down a huge chunk of Bank of America. And all the talking heads are like, oh, it's portfolio management. I mean, and then you look at his favorite statistic, which suggests that the world's about to end. And it just makes me think of one of my favorite Buffett quotes. It's my favorite, but I'll probably still say it wrong. But the core part of it was, you want to be careful when there's not a cloud in the sky, and you want to be greedy when you're in the middle of the storm. And right now, the S&P at 25 times earnings, even if you look out 3 years with 10% earnings growth, you're still at 18 and a half times. It's over 6,000. You got the Magnificent Seven trading very strongly. All the things we've just been talking about in the Buffett indicator at, close to 200%. Feels like that's a pretty cloudless sky, and it might be a good time to batten down the hatches and be aware that these good times don't last forever.
Austin, what are your thoughts?
In the late 90s, everyone was saying that Buffett was washed up because he was leaving the market as growth equities continued to race higher. And as you could see from this chart, in the late 90s, the actual multiple wasn't near where it is today. So it shouldn't be a surprise that Buffett's loosening up on his equity allocation as he sees some of the animal spirits kind of push markets higher in this environment. And I would just say, like, over the last 25 years, Buffett's seen his net worth double multiple times right after he was washed up. And in reality, people should be looking at the facts, understanding what's going on to fundamentals of companies and valuations. If you're really focused on that, the likelihood that one trend, whether it be the internet in the 90s or whether it be AI today, is going to significantly increase the market cap of equities beyond GDP growth is kind of outrageous. And people should position their portfolios accordingly. In this market, it likely means a little less Magnificent Seven. It likely means a little bit more small cap, a little bit more kind of blue collarish type companies that tend to do well in any environment. And also, quite surprisingly, probably a little bit more international, right? International has been tossed aside for the last decade, and these things tend to move in decade increments. So expect international to kind of come to the scene at some point here in the next few years.
Well, Austin, that's a great segue into our next chart from Bloomberg. Look at the S&P 500 trading at a 60% premium to global stocks. Given where we are today, especially when you're thinking about new money to add to a portfolio, Adam, what do you do with a chart like this?
Look, I think this chart also speaks to what we've been talking about, which is the idea of the Magnificent Seven driving the S&P 500, because the Nvidias and Facebooks and Googles and Teslas of the world are, U.S. domiciled companies, and outside of the United States, people have also been enamored with their performance and have piled into those equities. So as that trade unwinds, I also would expect to see some of this gap of the U.S. markets versus rest of the world to also, come together. And it could be a very good time to, as Austin said, you have a little more international exposure to make sure you have a global portfolio and aren't just, too focused on the U.S. given valuations.
Yeah. Austin, you already actually spoke to this chart. Any other thoughts on what investors should be thinking about as it relates to international investing?
I think it's really interesting to see that the significant dispersion in this chart comes following the U.S. government's just completely unloading of cash into the economy in the U.S., right? As we saw government take interest rates down to zero, as we saw these massive recovery programs where government's investing a ton of money into every corner of the economy, we've seen surprisingly the valuation of U.S. companies significantly outpace the valuation of international companies. Now, if the government can't continue to do that forever, you got to wonder, does this dispersion warrant this level of, I would say, extremeness into perpetuity? It probably doesn't. And with that in mind, you should think about, hey, maybe there are some other economies that will benefit if the U.S. government isn't just plowing boatloads of money into the economy.
I don't have a chart for this, but in 2009, 2010, if you were an investor, a financial advisor, or portfolio manager, and you'd been managing money for the past 10 years, if you were focused on cap-weighted investing, your returns were absolutely trounced by equal weight indices and international investing. And Austin, like you mentioned earlier, international investing tends to come in decade-long waves, and this really does look like the opportunity for investors to consider allocating overseas. One of the things to consider is, do you index overseas or does active management matter? Check out this chart here from the team over at Creative Planning, and it shows global equity returns this year across the globe, and there's a wide dispersion. Adam, how do you look at international investing from an active standpoint?
Look, I think this table does a great job of making the point that you can't just think of it as U.S. versus international. International, it's a lot of different countries facing a lot of different challenges, a lot of different political regimes, and a lot of different return profiles. So actively having a good chunk of your international exposure actively managed, where a manager can look at the different countries, at the different markets, find strong companies at discounted valuations, is what you want to do. And if you look at this chart and you think, wow, there's a lot of green, a lot of positive returns internationally, but the dispersion is massive, from Argentina at 45% positive return to Mexico at negative 23. That's a 60-70% swing between those two countries. So you want to make sure you're diversified internationally, but you also want to go to the places where valuation is the best and the opportunity is the best.
Austin, what are your thoughts?
I think it just highlights the value of active management in international markets, right? Because if you have a talented manager focusing on high quality companies in the best underlying economies, you're positioned to outperform just the broader indices, which is essentially owning a little bit of everything. I think that indexing in the US is considered kind of the holy grail right now, because as we discussed earlier, you've got a handful of companies that are, plowing the entire index higher. That's not always the best thing. And as those handful of companies kind of pull back the index a little bit, it might show that you don't want to just own, a few things, and you want to be more opportunistic in what you're buying instead of focusing on just, sprinkling your assets around to every different country or every different company available.
Let's wrap up our chart section with this table. This lays out the Bloomberg Ag returns and its drawdown, which we are currently in the longest drawdown the Bloomberg Ag has ever experienced. We've been talking all along about some of the risks in the fixed income market that really most investors, financial advisors, and portfolio managers are a little bit blind to. How do you take this chart and think about it in terms of total portfolio management? Austin, I'll start with you.
Yeah, it's interesting. I would say another aspect of this chart that is really telling is if you look at the last true drawdown, it was in 1980, right? 1981. If anyone's been watching the bond market and listening to Adam and my former, boss, Bill Gross, he talks about the end of the 30-year bull market in bonds. And we've definitely seen that start to come through in the past few years. And I think this chart could be the beginning of a very longer bear market in bonds, as you can't really see interest rates can't go much below zero, right? And so we kind of hit that lower level in 21, and then we've had inflation that's pushing things higher. What we've seen since then is we've seen higher volatility in the bond market and lower returns in the bond market. It's the worst formula for risk-adjusted returns one could expect. So as we think about asset allocation and investing in the bond market, we think about staying higher quality and shorter duration, where you can reduce that volatility and still generate decent returns given the shape of the current yield curve.
What are your thoughts, Adam?
Yeah, I'll answer it a slightly different way. And maybe this, I don't know if this is controversial or not, but when you go back to sort of pre-1980, and I'm sure I'm not getting the date exactly right, bonds weren't really traded. You bought it, you owned it until you got your principal back and you got your interest along the way, and that's what a bond was. And this 30-year bull market of bonds also corresponded to the rise of bonds as a tradable, more tradable asset, not dissimilar to the way people trade equities and stocks. And I can't help but wonder if bonds, in terms of how people think about them, might revert back a little bit, where instead of thinking about, what's going to, rates are moving around and all this stuff is happening, what's the value of my bond? Maybe I just want to buy something that I plan to hold to maturity and clip the coupon along the way. And then when it comes due, I'll buy another bond. And there's certainly a ton of risk in that as well. But it's not dissimilar to what a lot of people started doing when rates were elevated with U.S. Treasuries. I'll just buy short-term Treasuries, make a 5% return, and every 3 months I'll roll them over until rates go low enough that that's not a compelling return for me anymore. So we'll see what happens, but it wouldn't surprise me if some of the sort of some level the sort of philosophy around how bonds their role in the portfolio could change a little bit.
Yeah. So in the 1970s, bonds were called certificates of confiscation in jest in our industry. It's because inflation was creating havoc in the economy. If that sounds familiar, Gerald Ford's approach to beating inflation, he created pins that said, "Whip inflation now." And that was how they were going to approach solving that problem, while investors got absolutely trounced if they were allocating to fixed income. I think to your point, Adam, now that everything's securitized, you can jump in your portfolio and start selling out of these things. And it seems to me it could create longer term problems for people in a portfolio. And there's more risk in the fixed income market than even potentially the equity markets going forward. Let's transition into our insights for this episode. What is Trump's policy impact going to be over the next 12 months? Now, we don't do a lot of predicting here on this show, but it really, really is important to keep an eye on what could actually get through and what could not. Austin, let's start with you.
Yeah, I think it's interesting to kind of think through this one as probably not what will create new laws, but what can be impacted from kind of an executive order, because those are the things that are more likely to happen in the next 12 months. And over the past few weeks, we've seen that, it's going to be very hard even to get the bulk of the Republican Party behind some of these policies. So it should be thinking about how or what different kind of levers can the executive office pull to execute on some things going forward. And so if you think about talking about the Green New Deal, right, it's likely not just to go away. it's likely going to be altered in one way or another. Like the interpretation of the law might be altered. So instead of just everyone getting $7,500 for an electric vehicle if they want to purchase it, it's likely to be much more difficult to qualify for that $7,500. If we think about kind of Medicare Advantage, the current administration has been very difficult in their grading system, preventing some of the suppliers from receiving the reimbursement that they had expected. Going forward, you should expect the new administration to maybe adjust some of that grading to get things a bit more normalized and support growth in the broader economy. But I wouldn't expect to see significant policy changes, because it's very hard to get all of the people on board in Washington rowing in the same direction to get things accomplished.
Adam, what are your thoughts?
Yeah, I think Austin said it well. Look, I think the first day of the Trump presidency, we're going to see a bunch of executive orders, and the question is what are they? One of the reasons that tariffs has become such a buzzword is because it can be done without Congress, and whether again we might find out the very first day what's been a negotiation ploy and what's been we're slapping this tariff on, and the markets will react. So I think we'll learn a lot the first couple of days, and then we'll see how that plays out over time. We'll also see how much campaign rhetoric was bluster versus real. Trump went to a conference, a convention with all the crypto folks and said all the right things, and now there's this view that crypto is going to rip under the Trump administration. Well, he's gotten their vote. He doesn't need it again. So is that going to happen? Or was that all just, politics? We'll find out.
Earlier, you had mentioned the trade talk and the tariff talk being a negotiation ploy. Do you have your eye on anything that could really people aren't thinking about that could be impactful?
Well, look, Trump, whether it's on X or on Truth Social or whatever, said something about Canada and Mexico, and within a couple of days, the headlines were about his phone call with the president of Mexico and Prime Minister Trudeau and down in Florida meeting with him. So clearly, the threat of a substantial tariff impacting trade makes things happen. It gets Trudeau on a plane down to Florida to say, hey, let me just walk you through, if you do this, what the impact on Americans will be. And let's negotiate. So it seems clear to me that that's some sort of negotiation that's kind of going on, even before, 6 weeks, 8 weeks before, Trump officially takes office. Trump also promised us that he'd end the war in Ukraine before he even took office. And, that's a big, bold statement, which he likes to make. And, but even if it takes a few months, if something happens there that de-escalates the conflict, that's a positive thing for the world. Less geopolitical risk is always a good thing. So, we'll see.
The NAFTA tariffs, we already went through this, right? I mean, back in, it's 2018, 2019, Trump already said, hey, we're throwing tariffs on, Mexico and Canada, and he got concessions out of them. And I think it's just a rewind of that in many ways.
Austin, earlier you mentioned something about government-sponsored healthcare opportunities. Could you go a little bit deeper? What do you think those could look like in a Trump administration?
Yeah, I think the most obvious one is Medicare Advantage. And one of the things that's been happening with the current administration is there's a grading system that's used to determine how the government reimburses the healthcare companies for the different services that are provided. And if it's a 4-star rating, they get certain bonuses. If it's 5-star rating, they get other bonuses. And one of the things we've seen over the last year or two is the Biden administration has made grading much more difficult. And one example would be, I think Cigna has very publicly stated, historically, they were about 92% of their plans were actually 4-star rated. And last year, only 60% were 4-star rated, meaning that they weren't going to get millions of dollars of bonus payments from the federal government. That eats into valuations. And if you look at some of these Medicare Advantage companies, they're actually trading at huge discounts to the market while they have growth that's likely greater than the market. So I think there's a lot of opportunity there if the current administration uses some executive actions to adjust that grading and get the Medicare Advantage companies back to a normal reimbursement ratio, which allows them to be more profitable. And I think you'll see valuations recover with that. That being said, it's an executive action, so people aren't necessarily excited about it, and they probably won't get excited about it until they actually see it go into play.
Let's wrap up with this one. So we're sitting here in December of 2024. As always, people start to look at their portfolios and look for opportunities as you head into the next year. And really, we talk about the importance of active management when you're managing your money. Austin, as you looked at things heading into 2025, what should an active manager be looking at?
I think there's a ton of things that active managers need to be focused on, and the environment's changing, and I think it's something that most people don't appreciate. If you look at an active manager who's been in the business for 20 or 30 years, they're likely operating in an old-fashioned framework where they essentially just go buy stocks and they wait for them to hit their valuation. Buffett used to talk about this a lot back in the 80s and 90s. He isn't necessarily executing on that same approach today. And so people should be more aware of how the market's changing around them. Some of the awareness right now needs to be, hey, from an active perspective, maybe I don't own these companies that everyone thinks is going to take over the world. And maybe I focus on some other fundamentally advantaged companies that we can buy at a significant discount to market prices. And so one of the things we've seen as people kind of rush into indexing is you have these 7 companies who have elevated the valuation of the overall index, even though they don't have growth that's all that much greater than the broader index. So I think people should look underneath the surface and say, hey, where can I get some incremental growth from a fundamentally advantaged business and get it at a reasonable price? And they'll likely outperform going forward.
Adam, same question to you, but I'd love an international lens and your thoughts around active management.
Yeah, I guess I'll answer that in a couple ways. One, I think when you roll into anytime you're at year end and the market's at an all-time high, you want to take a hard look at your portfolio. Hopefully you've done well because the market's up. If you've lagged, try to understand why you've lagged, but don't necessarily chase it, because the reason you've lagged could very well be the reason that the market valuation is stretched. And I think there's an argument that you could make today around that. And then look at like what hasn't done as well, and should you be diversifying? And I think when you look at certain international markets, and then the charts the table that we showed earlier, there's some big opportunities internationally at much more reasonable valuations. And despite all the political rhetoric, despite everything going on, we're still living in a global economy. That's not going to change. And to be able to it's a good time, especially if you've done well, to sort of add some additional diversification to your portfolio. And a great layer to add if you don't have it is an international approach or a global approach. And odds are you don't. Odds are most people, most American-based, U.S.-based investors, odds are you do not have enough international exposure in your portfolio. So I would take a long, hard look at that and consider how much you might want to allocate, and it could be a good place to go. And just ask yourself, look, the market at an all-time high is not in and of itself a sell signal, but it's how are you going to feel if it goes down 20%? Are you going to feel stupid if you haven't done anything? Is there something you can do proactively to make sure that you'll feel smart? So those are the things I would consider, and I think international should be a big piece of any thought process around how to play or how to manage a portfolio in 2025.
Excellent. Thank you, gentlemen. To learn more about Opal Capital, please visit opalinvest.com.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.